What does it cost? This question is only relevant if we know what it is, why we're buying it, and how we're going to use it. In other words, what value am I getting out of it? And then there's also the who question, as in who is going to be partnering with me? Am I just buying a commodity or am I buying a long term strategic project where there's someone on the other side, maybe multiple people that I'm going to be partnering with? That's something to keep in mind as well. But I wanted to use the analogy of a mail in rebate. So, oftentimes when we ask what it costs, we're just focused on the sticker price, which doesn't really give us the full picture. Let's imagine we see two products on the shelf. It's the same product, and one of them costs $5 and the other one costs $100. Well, if that's all the information that we have, then obviously I'm going to buy the product for $5. Why would I pay 20 times more for the same product? That's ridiculous. But anyone who sees that should immediately be a little bit suspicious. Wait a minute. This can't be the same product because if it was, no business would sell the same product for $100 and $5 at the same time. That doesn't make any sense. No one would buy it for $100. So what if you find out that that $100 product, yes, you pay in $100, but then you get a $50 mail-in rebate. Now the net cost isn't really $100, is it? It's actually $50. And then the next year you get a $60 mail-in rebate. And then the next year you get an $80 mail-in rebate. And then the next year you get a $110 mail-in rebate. Well, now it's looking like a very different scenario, isn't it? We were focused on just the sticker price. We should have been looking at the total cost of ownership. It's the seen versus the unseen. We tend to focus on what we can see and we ignore what we cannot see, when oftentimes the biggest opportunities, the biggest nuggets are hidden under what we cannot see. The biggest example would be opportunity cost. We cannot see opportunity cost. But this goes back to term life insurance and whole life insurance. And let me be clear, both are good. Term life insurance is great, especially convertible term life insurance is a great solution. Whole life insurance is also great. And the value to you of whole life insurance depends a lot on you. What financial goals are you trying to accomplish? And then maybe whole life insurance might help you to accomplish those goals better. If it doesn't, then it's not really valuable to you. So I do have clients where we don't take out a whole life insurance policy, it's just term. It's very rare that I have a client where we just do whole life insurance and that's it. It does happen. Usually we start with term and we'll have some blend of term and whole life because both are great and both can accomplish different things. So the $5 product is more like term life insurance. You pay $5, you get the product, that's it. Very simple. The mail-in rebate scenario is more like whole life insurance, where yes, your sticker price is more, the premium outlay, the premium amount is higher, but the cost to you over the long run is actually negative because you end up getting more out of the policy in terms of cash value, not to mention the death benefit and all the other benefits you get with it than what you paid into it. Another big difference is that when you're paying that $5 for term, you're not actually buying the product, you're just renting it. So if you buy a 10-year term policy, really what you're doing is renting that death benefit for 10 years. You pay $5 every year for 10 years to rent that product, and then you lose it. You don't get to keep it. It's not yours. So obviously we know it's cheaper to rent a product than it is to buy it. When you pay your whole life insurance policy premium, you own that death benefit. It is yours. It will be paid. You actually bought the death benefit. You own the death benefit. You give me pennies, I give you dollars. We can say that with whole life insurance because that death benefit is real. It is permanent. It will be paid. And so really what we should be looking at more than the premium is what is your net out of pocket premium outlay? Meaning if I pay $100 and then I get a $50 mail-in rebate, really my net out of pocket cost is $50, not $100. So if I pay $100 in premium and I get $50 in cash value that's available to me right away, Well, really, my net out of pocket premium outlay is only $50, right? Let me show you what I mean. So here we have a very simple $3 million term policy. This is for a 35-year-old male, the best rating. We have a $3 million death benefit, and it's a 30-year term policy, not a 10-year term policy. The annual premium is $2,000. So we pay $2,000 a year for a $3 million death benefit. If we fast forward 30 years, when Mr. John Smith is 65, that will be the last year this term policy will be in force. And in year 31, the premium jumps way up to $107,000, which would be a ridiculous amount to pay for this death benefit. This policy assumes you're not going to keep it in force past year 30. The only reason to keep it in force past year 30 is if you had absolutely no options whatsoever and you needed that death benefit still. The term expires after 30 years, effectively. This is a convertible term policy, so I think convertible term policies are great. If we wanted to convert this to whole life, we could do so without underwriting. If we approach that 30th year and we still need a death benefit, we would still have options, even if something had happened to John's health. But that just shows you that this is renting that death benefit. You don't own it. If this was a non-convertible term, it would just be straight up 30 years, that's it. You would have no other options. Since this is a convertible term, it's renting with the option to own it if and when you want to. And you can convert it in chunks, which is great. So again, I love term. Term and whole life are not competing with each other. In fact, they're very complementary. They work well together. Term getting you the most death benefit for the least amount of money to make sure your family's protecting your insurability, and locking in your ability to take out future whole life policies if you want to. And then whole life can do a whole host of other things. In our case, typically we're trying to become our own bankers, building up capital inside of our whole life policy that we can then use strategically later. But this is just a premium. There's no mail-in rebate. There's no cash back. You just have that straight up premium amount. That's it. This policy well and truly costs $2,038 a year, and we get a $3 million death benefit. We also have the conversion privilege, but still, it's renting the death benefit. As opposed to a whole life insurance policy, this is the same person, same age, same rating, same gender. It's not the same death benefit. And I did that deliberately because with whole life insurance, we're usually not starting with the death benefit. That's usually not what we're solving for. When someone asks, what does $3 million in death benefit cost in a whole life? Well, that depends. What are you trying to accomplish? Where'd that $3 million number come from? Sometimes when we're designing a whole life policy, we do start with the death benefit, maybe if it's an estate planning case or something like that, but typically not. Typically, that's not what we're starting with. And we end up backing into the appropriate amount of death benefit to optimize the cash value accumulation. I'm deliberately not keeping the death benefit the same because that's typically the wrong way to think about whole life insurance. Even with term, where does the death benefit number come from? It's going to come from me and the insurance company explaining to you what human life value is, how yours is calculated, that kind of a thing. In this case, we're paying in a $25,000 premium, so significantly more expensive, more than 12 times what that term policy costs, and we're getting about half the death benefit. But when you pay that $25,000 premium, you have $16,000 of cash value available to you. So you pay $25, but then you get a mail-in rebate for $16. Your net out of pocket is really only $8. So that's this 8,000 number here. Your net out of pocket is really $8,000. That's really how much you're coming out of pocket because you have that $16,000 of cash value available to you in year one. What about year two? Year two, the mail-in rebate gets even better. I pay in $25,000 premium. My cash value grows by $18,000. I pay that same $25 cost. I get an $18 mail-in rebate. What's my net out of pocket? It's really $7. That's $7,000 number here. What about in year 3? I pay that same $25,000 premium. Now my cash value grows by $22,500. I pay that $25 cost and I get a mail-in rebate of $22.50. I get $22.50 in cash back. So really, I'm only out of pocket $2.50. In this case, I pay a $25,000 premium, but really my net out of pocket is just $2,500 in year 3. Then we go to year 4. Now I pay that $25,000 premium and my cash value grows by almost $27,000. In year 4, I pay a $25 cost, but I get a $27 mail-in rebate. I'm actually getting more in cash back than what I'm paying into that product. I pay a $25,000 premium, but my cash value grows by $27,000. Why would you not want to pay that premium? Why would you not want to pay that premium? This, by the way, is one of the reasons why the insurance company has to limit your ability to pay premium. If you could pay as much premium as you wanted in year 4, you would bankrupt the insurance company. You could just keep paying in premiums and getting more out of the policy than what you put into it. It wouldn't work. It wouldn't work. Notice how with Wall Street products like mutual funds, there's no qualification process. There's no underwriting. You can buy as much of it as you want all day long. They won't check your finances. They certainly won't check your health. You could lever up irresponsibly and throw all your money in the market and they're not going to stop you. With whole life insurance, it's different. You have to qualify and the insurance company will limit you. They won't give you more death benefit than is appropriate for your situation. They won't let you pay a higher premium than you can actually afford. And we sometimes have to justify to the insurance company why it's appropriate for a client to pay this high of a premium level. So if this is really such a terrible product, why do they have to limit your ability to buy it? Why is the insurance company limiting your ability to pay a premium? Isn't the premium income, profit to them? Yes, it is. But in order for this to work with actuarial science, there have to be limits. That's why I think convertible term is so important because it secures for you the contractual right to take out a whole life insurance policy and pay at least up to a certain level of premium. By year 4, you can see we're off to the races. Now the mail-in rebate, the cash back that we're getting is more than what we're paying in. And every year after that gets better. Year 5, we pay that $25,000 premium. Our cash value grows by nearly $30,000. Here's another thing that's important. The death benefit is growing too. If you pay $5 for that product is flat. It's the same. It does not improve over time. So in the example of that 30-year, $3 million term, it's $3 million the whole way through. The death benefit doesn't grow. You're paying the same premium for the same $3 million throughout all 30 years. With whole life insurance, your death benefit grows. Your death benefit grows over time. So it's the same premium, but you're paying for more death benefit. That's great. So not only does your cash value grows, but your death benefit grows. And we can think of this like a mortgage. You pay your mortgage payment into your house. Over time, both your equity in the house and the total value of your house both grow over time. In this case, there's no theoretical limit to how much the death benefit and the cash value can grow. If we scroll down, let's look at year 30. In year 30, in our term policy, year 30, we just have that same $3 million of term. We would have paid in $2,000 a year for 30 years. So what is that? $60,000. So $2,000 over 30 years, we would have paid in over $60,000 in premiums. And we would have only a $3 million death benefit, same as what we started with. Here in year 30, we now have nearly a $3 million death benefit. Remember, we started with 1.5. So the death benefit has doubled. We started with about 1.5 million. Now we have 3 million. In this example, we actually didn't pay premiums all the way at age 65. We actually stopped paying premiums here. There's some other things going on here that I'm not going to get into. But again, our death benefit has doubled over those 30 years. So the same $25,000 is now buying twice the death benefit as it was before. So over the course of that time, We paid in $725,000, $25,000 from age 35 to age 64. We paid in $725,000, and yet we have $1.6 million in cash value. We have more than double the amount of cash back, the amount of cash value versus what we paid in. This is a life insurance policy that more than pays for itself. The cost to you really is negative over the long run. The only costs are in the early years. So 1.6 million in cash value and a $2.9 million death benefit. Here we're going through the retirement income scenario. I've gone through that before. I'm not going to do it for the purposes of this exercise. But this is just to show you maybe another analogy. I like using analogies that might help you to think about how does a whole life insurance policy work? Asking what a whole life insurance policy costs is always the wrong question because it misses the point. We can make it cost whatever you want. It's a function of how we design it. The question is, what financial problem are you trying to solve? What financial goals do you have? And how do we best accomplish those? And depending on what those goals are, whole life insurance might have no part in it. There might not be a use case for whole life insurance. Usually, I think there is. At the very least, let's take your cash position, your safe, liquid, accessible capital, the money that you would have in a savings account, maybe in CDs, money market, bonds, and let's move that into whole life insurance and we'll improve the outcome. But there are more advanced use cases as well. But if you want to think about the cost, quote unquote, the question is the cost of what? Because there are multiple benefits that you get from whole life insurance, and there are all trade offs involved in it. So we could, as we are in this example, we're maximizing the cash value and the retirement income that we're going to get from this policy over the long run. We could do the opposite and maximize the permanent death benefit where we'd have a lot less cash value. We could also look at a different policy with a different carrier where we're maximizing, let's say, the long-term care benefits. There are long-term care benefits that come with these policies. It just depends on what you're trying to accomplish, and we'll structure the policy to suit your specific needs. But to think of that $25,000 premium payment as a cost is not really accurate. If we're going to think about costs, which yes, there are costs associated with whole life insurance, just like any other financial vehicle, there are costs. You just have to do the cost benefit analysis to see what makes sense. But really, you should be more focused on your net out of pocket premium outlay, which are these numbers here. So in year one, the premium amount is $25,000. But when you consider that you then have $16,000 of cash value available to you in that same year, really your net out of pocket outlay is just under $9,000. That's really the number. And that first year will be the worst year. The cash flow efficiency gets better every single year until we reach year 4, where you pay that $25,000 premium and your cash value grows by almost $27,000. You get a $27,000 mail-in rebate. You deposit $25,000 in this bank account, your account balance goes up by $27,000. If I give you a magic bank account where you can deposit $25,000 and your account balance goes up by $27,000, how many times are you going to make that deposit? So that's the important thing to keep in mind here. The premium amount is not necessarily the cost. And over the long run, the benefits you get from this policy, both in terms of the liquidity, the cash value, and everything else, death benefit, long-term care protection, creditor protection, policy loan feature, etc. All of those things dramatically outweigh the premiums that you're paying in. I hope this was helpful. We'll talk soon. Bye-bye.